Welcome to Energy Unplugged, the go-to podcast addressing the global energy transition. I'm Hugo Batten, Managing Director of Aurora across APAC. Delighted to be joined by two guests today, Phil Hirschhorn and Tim Nelson. Both guests recently authored a major review on market settings in Australia's NEM, and so it's extremely timely to have them both on the pod. Phil's been a BCG partner for 25 years before taking on this review. Tim was previously on the pod 6 years ago, so one of our very rare double appearances. There's not much he hasn't done in Australian energy, from the Reserve Bank of Australia to the New South Wales Government, AGL, AEMC, Iberdrola, and now chair of the review. Phil, Tim, welcome to Energy Unplugged. Delighted you can join us.
Very happy to be here. Thanks, Hugo.
Yeah, thanks, Hugo.
We're also joined today by Hana Ramli, Principal in Aurora's Australian Advisory Team. Welcome, Hana.
Great to be here.
Awesome. So, team, let's set the scene because some of our overseas listeners may not have come across the report just yet. So, can we just map out a few basic areas? So, to start off, what was the scope that you were given to solve here? And I suppose what was out of scope as well to help define the discussion?
Thanks, Hugo. Look, the review is called the NEM Review, although some colloquially call it the Nelson Review. The full name was the NEM Wholesale Market Settings Review. And that's what we're after. So the NEM, the National Electricity Market on the east coast of Australia, the wholesale market. So we're looking at the energy-only market, but also the aspects of the market that deal with derivatives and long-term investment markets on the wholesale side, but not looking directly at retail or network markets, for example. The review itself was about encouraging investment in firmed renewables in the system, but also dealing with the emerging weather-based system that we have in Australia and trying to get ahead of that curve. Things that weren't quite in scope. So we're not here to look at carbon pricing. We're not here to look at networks and retail markets.
Awesome. Super clear. And then maybe the kind of exam problem that you were asked to solve as a panel. And I think here we'll probably have to get into the weeds of what people perceive to be the issues with the NEM's current design as a wholesale-only, quite volatile market.
Yeah, sure. So I guess there's a clear aspect in our terms of reference, and that's about the resource adequacy question. How do we encourage investment in the system in firmed renewables? So renewable bulk energy, but also the storage and the firming resources that complete the system. But there's also the underlying question. We're moving in Australia quite rapidly to a very weather-based system with a lot of storage and a lot of distributed price-responsive resources. So a big part of the exam question has been, how do we make sure the system is ready for that ahead of time, right? And you can imagine a weather-based system. I think the phrase we've been using is it's going to be predictably more variable. So you'll get more seasonality, peaks in winter evenings and mornings, and unpredictably more volatile. So price spikes and price troughs. And so how do we set up the market to be resilient to those phenomena?
And then the process. So kind of where are we today and how much work do you guys still have to do to hit the finish line?
Yeah, so we've been around now doing the review for about 10 months now, Hugo. So we've got another few months to go. What we're required to do is by the end of this calendar year, we've got to provide a final report. We released our draft report at the beginning of August. And the draft report has recommendations across the spot, the short-term dispatch market, the medium-term derivatives market, and the long-term investment market. Energy ministers noted the report, asked us to cross the T's and dot the I's and come back by the end of the year with a report that has those actionable recommendations to deal with those issues that Phil was just talking about.
Awesome. And then could you summarize the major recommendations and perhaps for our listeners, break them out over those 3 time horizons, the spot market, the derivatives market, and then the longer term investment horizon?
Yeah, sure. So let me start with that spot market. As you mentioned before, Hugo, we have an energy-only mandatory gross pool here in Australia. It's a zonal system. We have a number of zones. It's not a nodal system. the key recommendation is a non-recommendation. It's to stick with that energy-only wholesale market. It's to not, therefore, move to other forms that you might see, capacity markets, where a real-time market, there's a recommendation not to create a physical day-ahead market. And so it's really stick with what we've got. It does a reasonably good job of efficiently dispatching resources in the short term. There are a few things that affect that. And one that we did know and have a big recommendation about is the increasing appearance of what we called hidden resources. So there are a number of, and a growing number of resources, my home battery, one of those, that accesses the market, but isn't part of price formation in the market. And that works when that's a small amount of resource, but when there are, thousands, and we're putting 1,000 household batteries in a day at the moment, that can affect the efficiency of the price formation if they're not participating. So there's a second recommendation in there that we find ways that those hidden resources become part of the price formation, either by bidding in the dispatch or by forming part of the demand forecast. A burden that wouldn't fall on households, but on the retailers who orchestrate those resources for them.
It's interesting, isn't it, Phil, that we heard loud and clear that the very reason people want to put batteries in is because of the energy-only market. So the actual dispatch is really useful for driving the right type of resource investment. But it will only lead to a long-term efficient outcome if you get that visibility so that it's forming price, getting the right level of investment. So those two recommendations kind of work hand in hand in the short-term market.
If I then move on, we recognise that if we keep the energy-only market in that increasingly weather-driven world of renewables, we have a different set of risks that generators and retailers have to manage. And so the recommendations in that derivatives market are about getting ahead of the game and getting ready for that. And so we are instigating a process, an industry-led process. We've got a group of 12 folk from the buy, the sell side, the trader side, to design some derivative contracts that reflect the risk of the new forms of generation and help manage the risk that retailers form in there. And those contracts would form part of a second recommendation, which is to instigate a market-making obligation around those contracts. So essentially creating a market where buyers and sellers come together around those derivative products. There's liquidity, it's accessible, and the pricing is transparent. So, establishing a set of new contracts and making sure that they are liquidly traded, that manage the risks in a weather-dependent system. And then the final set of recommendations are around the long-term investment. And the key unique insight we think here is about how do we connect those medium-term markets to the long-term markets. And so the investment signals we're looking at here is a program. Your listeners might not be familiar with the current mechanism in Australia for investment is called the Capacity Investment Scheme. It underwrites projects with a sort of bespoke cap collar type system. We still see a mechanism that involves supporting projects with long-term risk management, that our recommendation has it doing it using those same standard derivative contracts as the means of managing price risk. And we'd only do it for the tail end of a project's life. So keeping them contracting in the market for the first few years of their life, and then relying on this mechanism to be the buyer, if you will, of those contracts in the longer term. So at its heart, we're trying to connect that energy-only market through the derivatives market to the long-term investment market, sort of completing that chain.
Yeah, it's probably downplaying 240 pages to try and synthesize it this simply, but Phil's right that effectively all the report is really talking about is re-embracing the original NEM wholesale market design, but stretching it so the price signals that you can see as a consequence of it, not just in the short dispatch market, but then go over to the risk management and then that long-term investment timeframes.
That's a super helpful summary, team. And I should add for our overseas listeners, the report has been, I think, really well received to date by both government, but also the private sector. So now we're going to kind of dive into some of the trade-offs and challenges inherent in any market design exercise. So Hana, do you want to take it away on some of the trade-offs of greater central planning and involvement?
Yeah, sure. So trade-offs of greater central planning. I think both you, Tim, and Phil, you mentioned investment there. How would the panel propose minimizing the risk of over or maybe also under procurement? And what risks are there that the market-making organization incurs real losses here? For example, if they over-procure contracts that the market then doesn't require, because you're talking about medium and long-term here.
Yeah, and that's a great question, and I'll try to answer it over a bit of time. The first thing to recognize that matters here is we're proposing, as you say, sort of we'd call it not a central plan, but a hybrid central distributed planning approach. The key is that we're offering to buy contracts for that second part of a project's life. I'll use round numbers in the report. I think we use number 7, but let's say from years 5 to 15 of a project's life. That means it's contracting in market for the first 5 years. The second aspect is because we're using these standardized contracts, the operator of the mechanism is going to be required to return those contracts to market as time marches on. And that provides us with a few different sort of pieces of information for that planner. So you can imagine they'll start with some view of the trajectory of investment that is needed. But now they also have a feed forward signal and a feedback signal of whether they've got that trajectory right. The feed forward signal is that the projects are in market for the first 5 years. So they're either going to get a good price or a low price there. And what they ask for in the back end will balance that out. We get to see if those costs that have been proposed for the back end of those contracts, the back end contracts, is high versus, say, what the contracts are trading at in the market today or versus our estimate of their cost of LCOE. That provides a feed forward signal. If those gaps are too high, that's an indication that you're procuring too much. We also get a feedback signal. When the operator returns those contracts to market, they'll sell for a price which reflects their value in the market. If that's lower than what's being paid, that's an indication again that you bought too many. Or if they're making a gain, it's an indication perhaps you need to go back to market. And so we're complementing that planning process with 2 forms of market signal to keep it disciplined.
And transparency is the hallmark and the feature of kind of this recommendation, that if everyone can see what these prices look like, then it acts as a great discipline, not just on market participants to get the right amount of investment, but that procurer that's taking that tail risk of those investments. And that's where we see that price signal and that kind of long-term discovery of price acting as a great way of balancing the trade-offs of using the market with an element of central planning.
You mentioned that transparency signal. I guess it's natural for me to ask the next question, which is the contract design and or product type. How do you get contract design right? And I guess the next question to that is, what are some of the initial contracts that you would like to consider or see in the market as this evolves?
Yeah, that's a fantastic question. I think it's the $1 million question right now. The tricky answer is, actually, we want the industry to develop this, and we've established a working group to address this question and land on contracts that are both relevant for buyers and sellers. Actually, the recommendation is exactly that, to establish a regular process, and we're hoping to role model that in the last half of this year. Yeah, but what are the important attributes? I've emphasized before that this standardization and fungible nature of them is really important. It's what allows us to get that feed forward and feedback signals. And so we're looking for contracts that aren't specific to either the plant or the buyer. So those are going to be fungible type projects. Of course, you then have features that needs to be relevant to a retailer or other customer who's trying to hedge a portfolio. They need to be relevant to the generator or storage or other resource that needs to be financed. You want to allocate risks in the right way. We've heard many ideas. It's actually really exciting to hear some of the ideas. So we're confident that there are some that are out there. You see innovation in the OTC markets that we can draw on, things like time of day block contracts, things like profiles and shapes, and you can create ex ante and ex post versions of those. You can also draw on some of the literature you see in other markets. They're all about moving towards more fungible, standardized contracts.
And I think that's where the nature of the evolution of the market is really interesting, because most of the comments when this review was first stood up in the public debate were all around the spot market. They were all around the classic debates, which I know you've kind of heard people talking about, not just on your podcast, but globally. Should you have a capacity market? Should you have an ahead market? And what became super clear to us is that the big deficiency in the NEM at the moment is actually the evolution of contracts to keep pace with the physical evolution of firmed renewables. So as we get to that point where we're 30, 40 in South Australia now at 80% renewable energy, the contracts that are available today are still baseload swaps and caps. A baseload swap is entirely not the right contract for a market that's got a high penetration of renewables. So to Phil's earlier point, we break this into what a retailer would need. They need energy, they need shaping, they need firming. Firming and shaping is pretty solvable almost kind of today because the contracts exist today, a peak cap or an intraday swap or whatever it might be. The bulk renewables, that's probably a little more challenging, but to Phil's point, there's at least half a dozen examples that we've had put across our desk before this contract group's even met that all tick the box of they're useful to buyers, they're useful to sellers, and they can be fungible and traded. So we think this is something which is really important, not just for the market making obligation or the long-term investment signal, but it's just keeping up to speed with the reality of the physical evolution to a firmed renewable system.
I agree. The market is actually ripe for different type of contracts. Like the market actually do need to innovate at the very least.
Well, and I think what's obviously really smart about what you guys have done is because year 0 to 5 or 0 to 7, assets can still innovate and come up with their own bilateral or over-the-counter contract types. And then you can almost look at what's happening in those front years and adapt the suite of contracts over time if there are innovative, clever contracting structures being set up in that period of an asset's life. Transmission, probably the thorniest issue in the energy transition in Australia. So completely understand it's out of scope for the review. And I think a big part of the success of the review is that you guys have been very disciplined about staying focused on the question that was put in front of you. But for our overseas listeners, like a lot of grids, Australia's grid is challenged. We're seeing quite high rates of losses and curtailment, particularly for solar assets in different parts of the grid. This is true of all, I think, programs where we try to incentivize renewables into the grid faster. But do you see a risk that we're pushing more renewables into an already congested system? And then where would the risk of that congestion or losses sit under the review?
Yeah, obviously, the build-out of transmission is crucial to this, and the ability to build projects at speed in general and connect them matters. No market design works better under a world where there's a gap between the investment signal and the time it takes to respond to it. So we'd love to see that come down. So I think the key job here of solving this kind of, and the states are taking it on with renewable energy zones and transmission build-outs to open up new space for renewables. And that's something that the states are taking on, as you said, is not therefore part of our review. And there's one question you ask about who bears the risk of a congested transmission system. I guess, under the ESM mechanism, we've offered standardized contracts. So that's at least the proposal. And one thing that does come through that is that it places good incentive for project proponents to locate in the right place, whether that be for, obviously for capacity factor, but also for the profile of production. Am I producing into the high price events? And therefore also to locate in places where they won't be congested. And so there is some incentive and therefore I guess a little bit of risk that comes with that for plant if you're using these standardized approaches to optimize and find the best locations for their plant. And that's a good thing.
I guess the other thing that I'd add to what Phil mentioned is that what we've seen in many reviews into locational marginal pricing that's been conducted, into the market by various market kind of regulators and bodies over the years here in Australia. The one thing, there are probably two things that we noted through that. The first is that if you were to redesign the way that the spot market settles, that would take years to implement. And the one thing that we've heard loud and clear is that what investors desperately need and what customers desperately need is some degree of certainty so that they can get on with the job given the transition that's required. So that'd be point one. The second thing, though, is that we started looking around the world at, various, markets where they do have locational marginal pricing in some form. And what we noted is that none of the firm transmission rights that were being used to manage that risk went into an investor timeframe. So they were all generally very short-term in nature. So if I'm building a new wind farm or a new solar plant or a gas turbine or a pumped hydro project, it doesn't really help me if I can get 2 or 3 years of certainty around access to the transmission grid and the price if I need to kind of get that certainty over a 15 or a 20-year time frame to get the equity and debt into the project. So I think all over the world, this is going to become one of those issues which it's either generator-led or it's transmission operator-led / government-led. And in Australia, certainly at the moment, governments have taken that on, and it's a government centrally planned led view of transmission. And that's why we've got the renewable energy zones that are being developed, particularly in New South Wales.
I mean, if transmission's the hardest issue in the Australian energy transition, I'd say probably thinking through the timing of coal exits is the next hardest and most contentious. So certainly something a lot of Aurora subscribers bring up to us is that, Aurora, your forecasts are based on a certain timeline of coal exits. And so that creates gap for new capacity to enter and markets are in equilibrium and hopefully everyone makes some money. What we're seeing, I think, a little bit at the moment is there is a nervousness about how the system will operate as these big chunky coal plants exit and concerns about reliability. And therefore coal life might get extended by 2, 3, 4, even 5 years to assuage concerns about reliability. But then you've brought on a whole pile of renewable and firming capacity on the assumption that they're exiting in 2030 or 2032. And what you essentially end up is a kind of structurally oversupplied market. How does your review grapple with not just the entry problem, but also the exit problem of coal?
Well, I think, Hugo, the first question to ask is why does coal stick around post its announced use by dates? Why do governments feel the need to keep it in? And it's because the coal provides a bunch of services. They provide the bulk energy, they provide it in a firm way, and in many cases they also provide a set of system services around inertia or system strength. So the crucial thing is that the investment in each of those services needs to come through. And so that's one of the differences in our entry mechanism. I think we called it the ESEM, the Electricity Services Entry Mechanism, is that it's looking at all those services. There's a stream on bulk energy that would bring on renewables. There's a stream on shaping, which would bring on storage or demand response to move power from the middle of the day to the evening and morning peaks, or vice versa. And there's the firming, which might bring on very long duration storage or gas turbines to fill in those longer duration events where there's a lack of renewables or very high demand. And there's another piece which would add on to that to enable those new resources to add in provision of essential system services. And so if we're bringing all of those on in a timely manner, then the economics of the coal plants suggest that they should exit as they currently do. And the governments can feel comfortable letting them exit because they know with confidence that those services are there. And so that overhang problem, which comes about in our mind because you only replace half of the service, in the case we put in a lot of renewables, but not the firming capacity. Once you've overcome that, then the exit's more smoothly aligned with the entry.
And I think, Phil, the thing that we note as a panel is that the world's very different from what it was even 5 or 10 years ago. The coal retirements now are much closer to today by definition. And I know that sounds obvious after I say it, but what that means is that the real issue with coal closures now is governments feeling that they have no choice but to extend those coal plants because, to Phil's point, the right mix of those services aren't coming in to allow it to be replaced. And that's where, if you look into, say, the next decade, there is an awful lot of coal where the owners of those assets have done the responsible thing. They've said, here's the date that we think that we need this thing to cease operating for a whole bunch of reasons. With this type of framework in place that the panel is recommending, we actually see that the ability to kind of have that supply-demand balance managed relatively well, we think that exists because of the nature of where we're at with the exit and entry as it exists today.
One final question for me before I hand back to Hannah. And again, for our overseas listeners, in Australia, you've got the federal government, but you've also got states, and states play a very strong role in energy in Australia. And each of the Australian states has their own projects and decarbonisation goals. How, and it will be tricky, obviously, but how does the review think about incorporating different state objectives? Most tangibly, Victoria has a plan to roll out offshore wind at quite significant scale. I think the target 9 gigawatts by 2040 or something like that. How does the review think about those state-based objectives?
Yeah, and I think in part that's part of the success and support we've had to date is we've recognised that it's a federal system and the state governments have their own policy objectives and are the ones that are responsible for energy in our system. So that framework for entry we've described, it's a common framework, but respects the state objectives. And in some cases, state objectives have some specificity around them. As you say, in Victoria, there's an offshore wind target. Now, one of the things that's helpful to the review is that those targets form part of our national electricity law. They're in something called a target statement, and it sits in our national electricity law and is part of what's called our national electricity objective. And so this mechanism would have to work towards that objective and find ways to invest not invest itself, but encourage investment in those resources. And I guess, we've described the mechanism so far with these standardized contracts, and that will target those sorts of projects that face what we call the tenor gap, the inability to contract long term. Things like offshore wind and other technologies have additional barriers and may need additional support. And this mechanism would find that additional support within each of the jurisdictions that is needed.
Building on the discussion around entry and exit, I think a big part of the capacity that's entering is obviously battery. So the next question is with regards to battery bidding and optimization. So for our overseas listener, a big part of them understand that the NEM is one of the hottest battery markets in the world. So we think that, we will have approximately 15 gig of that by the late 2020s. In the review, you explore a couple of concepts as part of this. Could you expand on your thinking here and how the reviews actually factored this into the dynamics of your recommendation? So number one, competition between battery optimization softwares. So particularly in the context of 5-minute settlement. And then the second one, which is my personal favorite, is opportunity cost bidding of batteries. So, as opposed to pricing up to thermals.
They're really, really good questions, Hannah. And yeah, this is one of the areas where as energy economists, we've had to do a lot of evolution of our thinking, because one of the things that made electricity economics so interesting to study was the lack of inventory management, that all of the real-time production needing to meet real-time consumption was one of the things that differentiated it from most other markets and most other forms of economics. With the development of storage, cost-effective storage, most of us have had to go back to the textbooks and pull them out and say, well, hang on a minute, in a world of very, very low or zero short-run marginal cost energy production from renewables, how would a battery think about what it's prepared to pay for those megawatt hours when it's charging? At the moment, there's not as much of that thinking, simply because we don't have as many batteries. But in a world where you've got a lot of batteries, then you're in this new world where batteries could become the price setter. And for the first time in most electricity markets, you're going to see demand playing a key role in price formation outside of just peak demand. So the review looked at that, and that's one of the reasons why we came to the conclusion that the actual energy-only market would not only survive in this type of circumstance, but it's actually the most effective way of ensuring that you get the best price formation and most efficient price formation. In terms of the competition, though, and the nature of the way that batteries operate, the complexity of having a battery optimize across all of the frequency control markets and the energy market every 5 minutes, and then update their intentions for every subsequent 5 minutes for the foreseeable future, that creates an enormous amount of data, and the amount of bids that are going into the AEMO system is growing almost exponentially with the number of batteries that are being connected. Now, to manage that complexity, batteries are effectively managed by auto bidding software. Now, that auto bidding software, we could end up in a world where, you've effectively got, computers, bidding against computers. And we think that at the moment it's not necessarily a big issue, but in a world of 10 years from now, where every portfolio is effectively auto bid using software that's not only, kind of not human led, but it's also machine learning, kind of AI type software, it will become very challenging for competition regulators to enforce competition law if they don't get ahead of it now and start thinking about the way they would do that in the future. So to be really clear, we're not saying this is an issue today in the report, but we're saying that competition regulators should probably start turning their attention to it, because it could become an issue in the future. And there's two real reasons for that. You've got complexity across all of those different markets. It makes it very, very data intensive. And the second is that we're moving into a world where, computers are effectively little mini agents with kind of machine learning, and that will make it very, very challenging for those competition regulators to assess what's going on in real time.
It's a super interesting area of just competition law generally. I think there was a case in the US where there's it's 3 butter manufacturers or something where uploading data onto a algorithmic pricing platform, and now there's case law about that. And as you say, Tim, it feels like the kind of thing that's very hard to unpick retrospectively, but as policymakers, you need to set some guidelines and get ahead of the problem rather than trying to work out, a year or two after the event, whether there's been effective price collusion.
Absolutely, Hugo. And I guess the other element to this is that for the first time in the market's kind of history, you're going to have millions of mini power producers that are price responsive. Australia's been very lucky to have had the distributed solar revolution, where you've got millions of rooftops now covered in PV. But that PV was not really price responsive. It was resource responsive. If it was sunny, it was producing power. But in the world of 5 years from now, you're going to have millions of mini power stations that are price responsive. Now, for a lot of those power stations, they're going to be, effectively run by some type of software on behalf of those households. So it's not just a large-scale portfolio issue. It's an issue even for the behind-the-meter software as well. So getting ahead of it, to your point, I think it's a smart thing to do.
Great to hear that you're trying to look ahead without trying to look ahead. My next question is to do with, again, building on that entry and exit discussion earlier. So we're all aware of the vertically integrated utility that exists in the, NEM market with, a central buyer taking on more risk. Do you risk disintermediating the traditional vertically integrated utility, also known as the gentailer in the Australian market?
So, I mean, as you say, the gentailer model has sort of developed here in Australia, and there we've got a number of large integrated players. We think that's a valid business model. We don't want it to come at the expense of transparency in the market, and that's why we have things like the market making obligation as part of our recommendations. But I don't want to call it a central buyer, but because as I described before, it's kind of part centralized, part decentralized. But that mechanism is deliberately trying to take on the risk that the buyers, including the vertically integrated buyers, aren't taking on today. That back end risk from years 5 or 7 onwards that they're not taking on today. So it's taking on risk that the market isn't managing through the vertically integrated model or other models. And so I guess the idea is it takes that risk until such time as the market is willing to take it, and then it recycles those standardized contracts back into the market. So I guess I'd say it's not actually going to through that mechanism disintermediate anyone. It's actually just doing stuff the market, either vertically integrated or not, is not doing today. And of course, no one's mandating that investment be made through that ESM mechanism. Players are welcome to make their own investments, and the ESEM will adjust its trajectory to reflect that. So people are free to invest in their own right too.
I think we've covered quite a few questions. I would consider it deep dive, but obviously it doesn't beat actually reading the report. I'm going to ask a couple of questions now before we finish up. They're ad hoc question. I think here at Aurora, we agree what you're proposing is something genuinely quite innovative. When you were going through the process, were there any overseas market that you looked to for inspiration?
So I think one thing is true. There's no one market that we said we're going to try to emulate. But we did look at a lot of markets. We spoke to folk in New Zealand, we spoke to folk in Europe and the UK, we spoke to folk in the US, and really looked at different aspects of what they were doing and took bits that we liked that would augment the Australian market. I think one thing you said, Tim, is one piece of advice is, hey, you've got an energy only market, stick with it. It's almost there, stick with it, and do things that make sense in your context. So we took pieces from various markets and learned from various markets, but we didn't emulate anyone, if you will.
I think the other thing we did is we looked at adjacent markets, so not just energy markets, and tried to learn about the way other industries have solved similar types of problems with heavy fixed cost infrastructure investment, and also just the way financial markets kind of trade in other commodities. So, in particular, the issuing of bonds and how bond markets reveal long-term price discovery and those types of things.
What do you think is the difference between, this type of exercises that you undertaken as part of the review that get traction compared to the ones that do not? Because obviously I'm part of the industry. I've read a few different reviews, from Hilmer all the way to what it is now. What do you think are the ones that basically stick and the one that doesn't?
First of all, we're not claiming success just yet, right? We're working very hard. We're working very hard with industry and government to continue to dot the I's and cross the T's, as Tim described, and get to something that we can accept. But we were reminded the other day that the original NEM was put in place through an industry cooperation. It was industry coming together to find the solutions that worked for it. And I think actually that's where I need to give great credit to Tim. He's led the panel on a very heavily intensive engagement process, both with the state governments and with industry, and in genuine ways where we are taking unsolved problems to market bodies and their members to help them solve it with us. And so I think that's one thing that I'm proud of, and I think it owes a lot to Tim's leadership that we're doing well, and I hope that would contribute to it getting traction.
That's very kind of Phil to say that, but I think the other thing that, to be very fair to the people who picked the panel members, they picked 4 panel members who arrived at the task with very, very complementary skill sets, who work together really, really effectively and who don't have egos. And so where we've had great discussions, I think all four of us have walked away from at least one or two discussions having done a complete 180 on what we walked into the room thinking was the answer, because we were convinced by very clever fellow panel members that we needed to think about a problem differently. So I wouldn't necessarily say that, because to Phil's point, we've still got a lot of work to do to try and convince people that these recommendations are worth implementing. But I think that focus on ensuring that civil society and the industry and governments feel that they have co-designed this process, these recommendations, I think that's that's the thing that we really want to emphasize, that this is, we are but the synthesizers of all of this great information that has been put to us.
Yeah, synthesizers of the information that you're taking from the market and basically trying to provide solutions.
Let me finish up with a couple of rapid fire questions then that we ask at the end of every podcast. Tim, Phil, what's one out of consensus view that you hold on the energy transition that you think is at odds with the kind of general wisdom out there?
So the first one that I'd say, and some of your listeners who know my academic work will have a little chuckle here, that I'm on the academic record for the last kind of at least 15 years talking about the importance of certificated schemes and carbon pricing for driving the transition. Through this process, I've been convinced that they actually don't work for investment timeframe decision making. They're very useful for guiding operational decision making, but in that kind of like investment kind of time frame, I just don't think that they're the right answer to the question. And I know that's very much putting me at odds with the rest of my economist kind of siblings. Phil?
I don't know how out of consensus this is. The electricity sector is going to play a huge role in our decarbonisation, and it's decarbonising itself and decarbonising transport fuels and decarbonising gas usage. I think there's a temptation to try and do everything at once. My view here is actually you need to work really hard on the electricity system first, and then sequentially think about those other things. So let's get our electricity system dequalified, and then let's replace the fuels in our cars, and then replace the gas in our homes. Because if we try and do it all at once, we risk ending up with a prolonged use of coal in the system and everything electrified in coal. So I'm a big one for the sequential approach. Nail the electricity system first and then worry about others, where I think the consensus might be, let's try and do everything together.
One final question then. Who do you read or listen to in the energy space that you think is always good, thought-provoking, and relevant to your work? My answer here would be you two guys. Phil, you've written a brilliant series of articles for BCG. Tim, I love your academic work. I'm annoyed to hear that you're going back on certificate schemes because you've convinced me over the years. Who do you read or listen to that you find helpful?
Phil's increasing presence on LinkedIn is worth checking out. Your listeners will see that Phil's becoming a bit of a LinkedIn guru as it comes to explaining complicated energy market phenomena on LinkedIn. I'm going to give a massive shout out to a friend and colleague, Joel Gilmore. I think if there is one person in the Australian market who is underappreciated for his contributions to the literature, to the thinking that goes on, it's Joel. Of course, I would always say my mentor and friend, Paul Simshauser. If you want to know anything about the Australian energy market, Paul's your guy. And, he will wax lyrical if you contact him about what is going on. So be prepared. Phil, what do you think?
Well, look, I'd second that group, and please joined you guys at the Griffith University team too. But let me also give a plug for my former employers, the BCG Centre for Energy Impacts. They've got a team of great folk from around the world, so who are seeing everything from around the world, energy traders, economists, and people who are doing practical stuff. And they're putting out a great series at the moment on different aspects of the transition. What sort of price dynamics, what might we see? How might we think about dispatch in a world with lots of temporal possibilities. So they're having a look at that at the moment, and I think they're a great group to follow.
One last shout out, Hugo. A person whose research does come at the electricity market more from a climate and a governance and stakeholder theory perspective, but a good friend and colleague at the University of Adelaide, Tracy Dodd, I always kind of think her stuff is just fantastic and worth reading.
Absolutely. Lots to include in the show notes. And Phil, completely agree with the BCG stuff. Halfway through an excellent article on connection reform that they've just put out that's very, very good. Team, thanks so much for your time today. We've covered a huge amount there, I think, in about 50 minutes, and we're so grateful for your time. All the best. Thank you, Tim.
Thank you, Hugo. Thank you, Hannah.
Thank you, Phil.
Thanks, Hugo. Thanks, Hannah. It's been great to join you.
Yeah, and Hannah, thanks for facilitating with me.
Thank you, everyone.
That was Phil Hirschhorn and Tim Nelson, the authors of a major review on market settings in Australia's NM, talking to Hugo Batten, Managing Director of Aurora across APAC, and Hana Ramli, Principal in Aurora's Australian advisory team. Thanks for listening to Energy Unplugged. Do keep an eye on our podcast feed for more in-depth conversations with senior members of the energy industry. The best way to do this is to follow the podcast via whatever platform you use.